Welcome to the WealthWise Show, where financial success meets informed decisions. I'm your host, the Wise Investor, and I'm here to guide you through the fascinating world of finance and help you to make wise choices. Join us as we unravel the secrets of smart investing and effective money management strategies in the different realms of financial education. Remember, the information provided on this podcast is for informational purposes only and educational purposes only. Always consult a financial professional before making any major financial decisions. Now let's start the show. So next I want to talk about, first off, I think this is going to be where I cut. But welcome to another episode. This is a continuation from last week's episode that really is a continuation from a few seconds ago, because for me, it's a few seconds ago, but for you, it's been a week. Last week, we talked about the introduction to the S&P 500 and things like that. Just a disclaimer, I'm doing it again. Make sure you guys understand that this information is not to be used as personal finance advice. It is not meant to be used as personal finance advice. This is for educational purposes only, and my opinions are my opinions only. And please do not let them influence you to do anything without talking to your financial advisor that is, dedicated to you. So, back to what I was saying. Now I want to talk a little bit about the history of the S&P 500. I talked about it before. The S&P 500 was introduced in 1957. It was a stock market index to track the value of, 500 of the best companies that were listed on the stock exchange. And Standard & Poor's, they provided financial data because they did the credit rating for, certain investments and equities and things like that. So they know their stuff when it comes down to a company inside and out. And that's why they're really good at what they do. So, like I said, in 1957, the S&P 500 made its debut, and it was tracking 500 of, the top corporations. And then in 1969 through 1981, there was a bit of turmoil in those years. But let's talk about the early years. How the S&P 500 was able to come to fruition and, pretty much make one of the best investment strategies. I'm not going to say there is, because who knows? But yeah, they made one of the best investment strategies. And the S&P 500 is widely known as pretty much the representation of the U.S. stock market. And that's because it's really good. And they've been around for not as long as probably the other indexes, but they've been around long enough to where, the NASDAQ is relatively new. But I'm talking about like the Dow and things like that. And what I mean by relatively new, I mean like compared to these other indexes. But we're not talking about the NASDAQ and Dow. That's going to be in later episodes. But yes, the people mostly around the world view the S&P 500 as, the U.S. stock market, because, it tracks 500 of the best U.S. companies that is on the market. And typically, the S&P 500 is used for us as fiduciaries and traders and all sorts of things as like a big benchmark. I had to just say that again but it's used as a target, because it's really good. And so if you can be on par with the S&P 500 or even beat the S&P 500, you're almost considered a genius. If you can beat the S&P 500 consistently year over year, yeah, you're not listening to this podcast. You might have an island somewhere getting fed grapes by your AI robots. So yeah, that's why the S&P 500 is one of the most important aspects of the U.S. markets. And of course, it had its trouble. You had different recessions and things like that. But because the S&P 500 has the best 500 companies in it, it also is used as a leading indicator of the economy. I know, shocking. So basically, if you look at the recession in 1980 through 1982, and then also the recession in 07 through 08, and go do your research on, this is more like looking at the charts, really. You can see that during those times when things got really bad for the, I would say the everyday folks, the S&P 500 and basically most all the indices were showing signs of distress. And then we did just have a 10-year bull market from 08 to 2020, where we also had the coronavirus pandemic, and we had that crash, and now we have inflation. And I'm basically giving you a very short and fast rundown of the S&P 500 history. But pretty much the S&P 500 has been resilient over a lot of these things, over the gradual decline when the U.S. or in the U.S. economy from the 70s to the 80s, the 08 stuff, the 2020 stuff. You can see how if you look at the market today, it might, like right now I'm recording this in October. So when you're probably hearing this is not going to be October 2023. So when you hear this, you're not going to know what I'm talking about. Who knows where the market's going to be at. But as of right now, we are in a downturn. But look at the history. We're still higher. Like if you look at the markets in 1981 to now, if you bought in 1981, I hate using that terminology. Like if you had a bought in such and such, I wasn't born in 1981. I'm 30 years old. I was born in 93. But I'm using that as a, hey, the market has been resilient. I'm not going to say it's perfect, but it has been resilient to a lot of stuff that's been thrown at it. And the S&P 500 is one of the better ones. So pretty much, that's pretty much the history of the S&P 500. Hopefully that makes sense. I know this is a short episode. And I'm probably going to give you guys a little something else because it is a short episode. And I explained the history pretty quickly. So I want to talk about a little bit more about the S&P 500. Let's go into, I'm going to give you guys, I've been boring you with the history. I've been boring you with the details. How can you invest in the S&P 500? That's something that I kind of hinted on earlier. But I'm pretty sure if you want to look into it, you're going to want to know how can you invest, because you can't just invest it directly into the S&P 500, which I've stated before. You have to go through ETFs and all that stuff. But let's go a little bit deeper. What about the sectors of the S&P 500? So I know, like I said, I went through the history pretty quickly and I feel bad. So I'm going to give you guys a little something. Now I think is more valuable than the history of the S&P 500, which is, the sectors of the S&P 500. So now you might say, well, okay, what do you mean by sectors? So for those of you who don't know what sectors are, basically think of it like sections. The S&P 500 is broken up. Think of it as broken up into different sections of the S&P 500. So remember I was saying, like, if you have 500, sorry, that's my chair. 500 of the best companies, and you divide them up equally. Well, what if you, instead of dividing them up equally by their market cap, you divide them up by what they do, what category they're in. Sorry, I'm not trying to move too much because my chair is squeaking. But what category they're in. And it can get pretty, what's the word I'm looking for? It can get pretty complicated at times if you really start thinking about it, because not only you're thinking about what sector, what about subsectors and all that stuff, and it's just, So the S&P 500 is made up of a few sectors, and I'm going to go down the list. I'm going to say technology. Now I'm going to say technology is one of the sectors. Industrials, energy, communication services, utilities, healthcare, consumer defense, real estate, financial, consumer cyclical, and basic materials. So that's 11 sectors. So the S&P 500, if you think about it, is divided up into 11 sectors. And I'm going to say, let's say for example, industrials. All the companies that the S&P categorize as industrial, that's the sector they're going to place them in. And the reason I say the S&P, because, there has been some debate about sometimes S&P putting certain companies in certain sectors that, the company doesn't really fit that description. But that's just, honestly, just opinions. Like the famous one is Tesla. Tesla entered the S&P 500 a few years ago. And when they enter in, they put them in the consumer discretionary sector. And, consumer discretionary is like, your Nike, your Targets and stuff like that. And so they're like, and people got a little offended by it because they view Tesla as a technology company and not a car company. So that's why I'm saying the S&P decides where these companies go. But yes, there's 11 different sectors. And if you break down those sectors, you can see how the S&P, like the inner workings of it. But let's go back to how to invest. So you have those sectors. You can do one or two things. You can invest in the S&P as a whole through a index ETF. You can buy a S&P 500 fund or ETF. You can buy a mutual fund or go on to any broker platform and buy shares of a ETF of the S&P 500. I mentioned it's SPY. Now, once again, disclaimer: I'm not endorsing SPY. I'm not endorsing State Street. I personally, like State Street. I have used their products in the past, and I probably will continue to use their products in the future, but that doesn't mean I'm telling you that you should use their products. I'm just stating, giving you examples of things you can do in terms of buying the S&P 500 indexes through the funds and ETFs and such. And you can put the S&P 500 is if you buy shares of it, you can buy it for retirement accounts and 401ks and all that good stuff. Excuse me. But so you can definitely look into just buying the S&P as a whole. But I would say, one, talk to your financial advisor. But two, if you like to let everyone do the legwork and you just, sit back and enjoy the ride, then yes, maybe buying the whole entire fund or the whole entire index, it would be ideal. Now, when you do that, you're buying think of the entire U.S. stock market. So you do have some advantages because you're invested in all 500 companies. Or not, you're not invested in all 500 companies. Like if you buy the ETF, let me explain. If you buy the ETF, you're giving money to a fund, an exchange traded fund. And what that fund does is go out, take that money, and it invests in all those companies. So you don't own, like let's say Apple, if you buy the S&P 500 ETF, but you're exposed to Apple. If you do you're exposed to the gains and the potential losses and potential gains of the Apple stocks that the fund purchases. I just had to clear that up. But so you're exposed to, the whole host of all the sectors, and there is I'm not gonna be able to say that word. Cyclical. See, I did it. Rotation. And so the sectors rotate. You probably heard of that. I'm going to explain that in another episode, but just to give you a preview, if you are in the entire basket of the S&P 500, when the sectors rotate, you don't have to worry about that because you got them all, or you're exposed to them all. And so you don't have to have super intensive analysts neither, because the S&P, they do it for you. The ETF do it for you. So you can do it like that. Now, the good thing about buying the sectors, though, is now for those of you who want to go a little bit more in the weeds, want to play a little more of a hand and role in your investment strategies and stuff like that. Now you can look at the different sectors. Now, let's say, for example, you say, "Oh, well, I'm a huge fan of technology, and I really don't care too much about healthcare. I'm not a big fan of healthcare. I'm not a big fan of big pharma. I don't care about all that stuff. I just care about technology. I love Nike. I love Tesla. I love McDonald's. I love Walmart." And by the way, guys, I'm going to say it one more time. This is the last time I'm going to say it this episode, but I just want to make sure it is completely heard that I am not suggesting, you go purchase these things whatsoever. No, not even close. These are just examples that I'm using. But back to what I was saying. Let's say, you're not a big fan of oil companies. You're very conscious of, some of the news and stuff like that. You're like, hey, I'm not a big fan of oil, but I do like real estate. So now, instead of buying the whole basket, you can just go and buy the sectors using ETFs. And State Street do have some good products. Now, once again, I'm not endorsed by State Street. It's not sponsored. I'm just using them because this is just what I've personally have used in the past. So you can do their technology ETF, XLK. It's a ticker. You got consumer discretionary, where you're gonna have your your Teslas and Targets and Starbucks. And so now you can mix and match. Let's say you don't like XLY or XLK because you're not a big fan of technology. You're afraid AI is going to take over the world. You think we need to get back to building roads, and and you like Cat, you like Honeywell, you like those type of companies, and you do like energy companies. You think you're an oil man, and you like banks. So you can go with the XLE energy. You can go with industrials, the XLI. You can do XLB for materials. So now you are invested in the different sectors of the S&P 500 and not just as a whole. So now you're taking one index, and now you're customizing that one index for any of your needs. That's actually one of the reasons why I like the S&P 500. But because it is easily customizable to your needs. There's tons of products out there, and not just State Street. You got Investco's, you got Vanguard, you got BlackRock products, you got Sterling Capital products, you got all sorts of products that track the S&P 500. iShares is a BlackRock product. I know I said BlackRock, but I wanted to mention the actual funds name, since I said State Street and SPY and all that stuff. So there's tons of different money manager or asset managers out there that do this for a living. They do this for you. So if you want to invest in the S&P 500, you can do an index ETF. You can do a mutual fund that tracks the S&P 500, or you can do the sectors. There's tons of different, like Invesco's got different sector funds for the S&P 500 and things like that. And now you can mix and match. But I'm going to go take one step deeper. And because I ran through what I was supposed to talk about today pretty quickly with the history, I'm going to take it a step deeper. Now that you know what kind of sectors you enjoy of the S&P 500, you already know, like, hey, you talk to your fiduciary, like, I think the S&P 500 works for me. They feel like it works for you. And now, you picked out your sectors. Now, remember when I was saying if you own the fund, you're not owning the shares of the company that's in the fund. You just own the shares of the fund. Not, you don't have exposure. You have exposure to the companies, but you don't own those companies. But let's say you want to own those companies. Now you can take a look under the hood, because they have to disclose these things. You can take a look under the hood. I'm like, hey man, I like S&P 500. I like the technology sector. What categories, or what are the best companies in the technology sector? What are their holdings? What are the index weight for their holdings? Right now, the top holdings in the technology sector is Microsoft and Apple. So you might say, well, I like Microsoft and Apple. Microsoft and Apple actually makes up almost 50% of the technology sector. So you say, well, I like Apple and Microsoft. Or you might say, I don't like Apple and Microsoft. But guess what? The technology sector, and I'm using the technology sector as an example. I'm not suggesting like, hey, go with technology. I'm just using that as an example. Actually, I'm gonna use a different example, because I'm not gonna lie, I am biased to technology. I'm Gen millennial. I don't know what that is. So I do like technology. So I'm gonna go with something I don't know too much about, and that's materials. All right. So if you look into the material sector, you might be like, hey, I like Air Products and Chemicals Inc. I don't know what Air Products Chemical Inc. is, but I'm assuming they do air products and chemicals and ink. That was a joke. I like Sherwin Williams. I think they're a paint company. So you might be like, I like these things. I like DuPont. I like New Mount. And you can now go over strategy with your financial advisor to try to fit some of those individual companies of actually owning them. And the reason why I think it's important that we actually own the actual companies that we like is because now you have equity in those companies. Right now, if you buy the funds are great. ETFs are great. I'm not knocking that. I use them. I recommend them to my clients. I recommend them to myself, and that's because they do make investing easier. But if you're one of those people who want, let's say you're a little bit younger, you're in your 30s, you're in your 20s, you're in your early 40s, you want to build equity up in companies that you like, well, then these are easy ways to find those companies. And you might even find companies in the sector that you don't know about that are competitors. Like, NVIDIA and AMD are notable companies that are competitors in the chip space. But what about the companies that actually make the chips? Not just, I'm going back to technology. Sorry. I just went back to technology. Well, because I like it. That's what I know. So, you might say, well, what about Texas Instruments and Taiwan Semiconductor? What about them? Or AMAT, Applied Materials. So in doing your due process and due diligence, this actually turned into a fundamental analysis due diligence episode. But you can use the S&P. You can see how the S&P can be so customizable, so broad that it will allow you to do pretty much almost anything you want. And that is why it is one of the best indexes that, I would say ever invented. I'm not going to say the best because, I don't deal in absolutes in that sense. But, it is one of the best at the moment. So, there are tons of ways to look into, it's for anyone. If you are just an older person, you're in your late 70s, early 80s, or late 50s, early 60s, and, I'm about to retire. I don't feel like, doing all that. Well, then just go buy you some, or not go buy you some. I'm not saying that. Go talk to your financial advisor and, have them come up with a nice plan that's easy for you. Hey, here's some ideas that we think that's going to be easy for you. They're all ETFs. And you let everyone else do all the work for you. But if you're a little younger and you like, hey man, I really like this investing thing, and I like companies and I want to build up equity in some of these companies, hey, why not? And the S&P 500 has 500 of the best companies, but not just 500 best companies. Like I talked about in the last episode, they have 600 of small caps, they have 400 of mid caps. So they do their research when it comes down to these companies. And instead of you going out and hitting the ground, actually putting boots to the ground and trying to find these companies, these, companies have already done majority of the heavy lifting, and now just you to read, honestly, go through the paperwork, go through the different companies, go through the, if you looking at an ETF, go through the prospectus and look at what they invest in, their strategies and all that stuff. Now, of course, that's my job. Now you get into, my job. But if you are someone who don't want a financial advisor, and, I still recommend them, you can do your own research. And that's pretty much how you do your own research. So that's going to be it for this episode. I don't know where I'm going to stop at, but yeah, that's going to be it for this episode, guys. I really appreciate it. The next episode might be a part 3 about the S&P 500. I don't know. We'll see. We talked about it a lot in the last 2 episodes. Right now I'm recording this as one big episode, so it's been about 45 minutes. If I do the math on that, 45 minutes divided by 3, that's 15 minutes apiece. I can get probably 3 episodes out of this. I'm just kidding. Maybe not. No, there's too many cuts and stuff. I'm just going to keep it as 2. So I don't want to make it too long. Point is, guys, I appreciate you listening. I thank you for joining me on another wonderful, enlightening, WealthWise journey. And, next week's episode, I don't know what's going to be about, but I think I'm going to continue on the track of discussing the indexes. And who knows, next week might be the NASDAQ. We'll see. Might be the Dow, might be the Russell, might be an index we never heard of. It might be the Nifty 50. I don't know. Nifty 50 is a real thing. Go look it up. But anywho, guys, I appreciate it. I'll talk to you guys. I'm not talking to you. Well, I guess I am talking. You're not talking back. I will talk to you guys whenever you're listening to my voice. I'm rambling. Point is, thank you. I appreciate it. Until next time, stay WealthWise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. any insurance, consulting, and education services offered through the WealthWise Show. The WealthWise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.